In 2025, China posted a trade surplus exceeding $1 trillion, a staggering figure that forces us to rethink the very foundations of the global financial system. This milestone isn't just a number, it's a wake-up call for economists, policymakers, and businesses around the world. This isn't just a record, it's a declaration of economic might, the result of decades of strategic planning, relentless industrialization, and a focus on becoming the world's manufacturing powerhouse. China's rise has been methodical, driven by both government policy and private innovation. But such a massive surplus raises a critical question. Has China's economy become too big to fail? The scale of its influence now stretches far beyond its borders, impacting everything from global supply chains to currency markets. The world's dependence on China now rivals the way we once viewed major banks: systemic, central, and risky if destabilized. Every major economy from the US to Europe and beyond is intertwined with China's fortunes. This surplus is a symbol of China's export power, but it also highlights a paradox: immense external strength yet growing internal vulnerabilities. The country's outward success masks deep-seated issues at home. Every day, China accumulates nearly $3 billion more from exports than it spends on imports. This relentless inflow of foreign currency has made China a financial juggernaut, but it also creates new pressures. This wealth is built on a dramatic shift from low-cost goods to dominance in high-tech sectors and green energy. China now leads in electric vehicles, solar panels, and wind turbines, reshaping the global landscape of innovation. Yet beneath this success, China faces serious domestic challenges: real estate turmoil, a shrinking population, and weak consumer spending. These issues threaten to undermine the very foundation of its economic miracle. The question is not if China's economy matters, but how its internal struggles will shape our collective future. As the world watches, the answer to this trillion-dollar question will define the next era of global prosperity and risk. China's trillion-dollar trade surplus is not just a number, it's a symbol of a dramatic economic journey that has reshaped the global landscape. This transformation began over 40 years ago, when China started opening up its economy and embracing market reforms, setting the stage for unprecedented growth. In the 1980s and 90s, China rapidly became the world's factory, churning out low-cost goods for Western brands and filling store shelves across the globe with made-in-China products. But this was just the beginning. Beijing's real ambition was to climb the value chain, moving from basic manufacturing to more sophisticated high-tech industries. After joining the World Trade Organization in 2001, China supercharged its export-led growth, attracting foreign investment and technology, but soon shifted its focus to innovation in high-tech sectors. Ambitious policies like Made in China 2025 fueled massive investment in research and development, nurturing domestic champions in fields like robotics, biotech, and artificial intelligence. Today, China's exports are dominated by advanced semiconductors, cutting-edge medical equipment, electric vehicles, and renewable energy components, reflecting its new status as a global tech powerhouse. Trade tensions with the West, including tariffs and restrictions, only accelerated China's push for self-sufficiency, innovation, and the search for new markets beyond traditional partners. Through the ambitious Belt and Road Initiative, China diversified its export destinations, forging new trade routes and partnerships, especially in emerging economies across Asia, Africa, and the Middle East. The result is a resilient, technologically advanced export ecosystem, capable of adapting to global shifts and challenges. Today, the trillion-dollar surplus stands as the payoff for decades of calculated state-driven economic strategy, relentless innovation, and a vision to lead on the world stage. China's trade surplus is powered by a few key industries that have become global leaders. The electronics sector has evolved from simple assembly to exporting homegrown technology, think Huawei, and advanced components for global brands. In electric vehicles, companies like BYD and NIO have captured markets worldwide, outpacing Western rivals on price and innovation. State-backed policies provide Chinese firms with low-cost loans, land, and research support, creating a formidable competitive edge. This model allows Chinese companies to take risks and undercut foreign competitors without sacrificing innovation. The result is a broad, diversified export machine. From solar panels to drones, Chinese products are everywhere. If one sector faces headwinds, another surges ahead. This intricate network of industries is what pushed China's trade balance past the trillion-dollar mark. Export dominance is no longer about one product, it's an entire ecosystem firing on all cylinders. China's export strength increasingly comes from green technology, solar panels, wind turbines, and batteries. Through massive state investment, China now controls over 80% of the global solar supply chain, making renewable energy cheaper worldwide. This dominance has accelerated the global shift away from fossil fuels, but it's also created a critical dependency. Most countries rely on China for the hardware needed to meet climate goals. Chinese wind turbines and solar panels are now the default choice for developing and developed nations alike. While this makes climate action more affordable, it also concentrates a vital industry in one nation's hands. The trillion-dollar surplus is fueled in part by the world's climate ambitions. Policymakers now face a dilemma, balancing environmental progress with economic security. Despite its export power, China's economy is deeply imbalanced. Domestic consumption remains weak. Chinese households save more and spend less, wary of an inadequate social safety net and rising costs. This makes China heavily reliant on foreign demand. When global markets slow, China has little cushion. The COVID-19 pandemic exposed this flaw, as Beijing doubled down on production instead of boosting consumption. Demographics are another challenge. China's population is shrinking, and its workforce is aging. Fewer workers and consumers mean slower growth and more strain on pensions and healthcare. These weaknesses contrast sharply with China's export numbers. The economy looks like a fortress from the outside, but inside, cracks are widening. The government knows the risks, but solutions, like building a stronger safety net or reversing demographic decline, are slow and difficult. For now, China leans on exports, perpetuating the very imbalance that makes it vulnerable. China's real estate crisis is its most pressing internal threat. For years, property fueled growth and household wealth, but a debt-fueled bubble has now burst. Defaults by giants like Evergrande triggered a collapse in sales and prices, eroding household wealth and confidence. And you would see negative wealth effect further suppresses consumer spending, deepening the consumption problem. The crisis has spread to banks, with rising bad loans threatening financial stability, especially for smaller lenders. Local governments, once reliant on land sales, now face fiscal crises as revenue dries up. Rescue packages and liquidity injections are only temporary fixes. The sheer volume of bad debt is a ticking time bomb, and local governments are struggling to fund basic services. The real estate dragon's heavy tail is dragging down every aspect of China's domestic economy. China's economic troubles don't stay within its borders, they ripple across the globe. A slowdown in China disrupts global supply chains, causing shortages and higher costs for businesses everywhere. Commodity exporters like Brazil and Australia are hit hard as China's demand for raw materials drops. Multinational corporations lose a key market, impacting profits and jobs worldwide. China is now both a factory and a major consumer in the global economy. A financial crisis in China could trigger global market volatility, especially if it's forced to sell foreign assets or recall loans. While China's foreign reserves offer some protection, a severe downturn could overwhelm even those defenses. The world's economic fate is now deeply tied to China's ability to manage its internal challenges. China stands at a crossroads. Its future depends on how it manages both its strengths and vulnerabilities. The nation's rapid transformation over the past decades has brought prosperity, but also exposed deep structural challenges that now demand urgent attention. The optimistic path requires bold reforms, building a stronger social safety net to support an aging population, restructuring real estate debt to stabilize the housing market, and finding new, sustainable revenue streams for local governments, which have long relied on land sales and borrowing. By focusing on innovation, investing in education, and moving up the value chain, China could maintain its export strength even as its workforce shrinks and global competition intensifies. But a more pessimistic scenario looms. If reforms stall, the property market stagnates and demographic decline accelerates, economic momentum could falter. In that case, China might double down on exports to drive growth, risking new trade wars, rising tensions with major partners, and greater global instability. Persistent economic frustration could lead to social unrest as citizens demand better opportunities and security. This could push China toward a more aggressive geopolitical stance, increasing risks for the region and the world. The key question remains: does Beijing have the political will and vision to pursue deep, sometimes painful reforms, even when they challenge entrenched interests? Relying on the old playbook of debt-fueled growth and export surpluses is a path of diminishing returns, unlikely to deliver long-term stability. The choices China makes now will shape not just its own future, but the world's, affecting global markets, innovation, and the balance of power for generations to come. China's trillion-dollar trade surplus is both a symbol of success and a warning sign. It reflects unmatched manufacturing power but also deep internal stress, property woes, a shrinking population, and weak demand. The world depends on China for goods, markets, and stability. A crisis in China would quickly become a global crisis. The future hinges on China's ability to balance external strength with internal reform. There are no easy answers, only complex trade-offs for both Beijing and the world. In our interconnected era, the stability of one is essential for the prosperity of all. The real question isn't whether China will affect us, but how we'll manage the consequences, together.